Does it really matter if the gold price goes down to $4,000 or something like that?
The Central Bank of Turkey, of course, has been selling, also swapping, buying back again. But the Central Bank of Russia has also been reducing its gold position. China has been, for 18 months in a row, has been buying.
The commercial banks in Turkey deposit their gold with the central bank. The central bank uses gold leases as a means of regulating the money supply. This is a managed currency. And gold is central to the management of the currency. So these transactions that go backwards and forwards doesn't mean that gold is going into the market. No, it's not. The Central Bank of Russia has in its reserve position, there are two other sovereign wealth funds which hold gold. And if you put it all together, they've got probably about 12,000 tons. More than America says it has, which it probably hasn't. One big question, why $8,000? And if the currency goes to zero, the value of gold in that currency goes to infinity. So I really just don't see the point of saying it's going to be $8,000 or whatever.
This week also we had the annual Gold We Trust report. I'm not sure if you've read it. It was just published, I think, yesterday. It's always an amazing report by Ronnie and his guys. He says the gold bull market is built on rock, not on sand. I was just wondering, though, how much lower do gold and silver need to go, though, to conclude the bull market is at least temporarily over? Do you have any level in mind?
Yeah, I don't care. Look, it's completely irrelevant. What you've got to bear in mind is that what is going on at government level with all the debt and all the rest of it is the destruction of currencies. That's what's going down. It's not gold or silver rising. Well, I mean, obviously they are affected in the sense that they are rising basically because the people who really know what they're doing, central bankers in the Asian markets in particular, are just getting the hell out of it. Do you really dispute that? Does it really matter if, let's say, the gold price goes down to $4,000 or something like that? I mean, God, you say, well, thank God for that. I can get out of these damn dollars. That's actually what you should be looking at. This idea that you're going to trade this, forget it. This is not a market for trading. It's a market for protecting yourself. Just get the hell out of risk. Understand where that risk is and just get out of it. So
to play devil's advocate,
I really don't care what the price is. I really don't. It doesn't matter.
Gold falling can scare retail investors faster than currency erosion ever will. Alasdair Macleod notes, the deeper issue is not metal volatility, but whether debt-heavy governments are quietly destroying purchasing power faster than markets admit. When investors obsess over short-term price levels, they often ignore why central banks keep diversifying reserves while confidence in fiat weakens underneath. For savers, the real threat is mistaking temporary pullbacks for broken fundamentals. Next, Alasdair Macleod reveals what policymakers cannot stabilize without exposing larger currency risk.
The Central Bank of Turkey, of course, has been selling, also swapping, buying back again. But the Central Bank of Russia has also been reducing its gold position. And then again, China has been, for 18 months in a row, has been buying. So just want to also bring another perspective here that perhaps some central banks have been selling, which could also lead to downward pressure.
Paul, can I just address that point? One of the central banks which sells, or was reported as a big seller, was the Turkish central bank. What people don't understand is that the commercial banks in Turkey deposit their gold with the central bank. The central bank uses gold leases, whatever, into its commercial banking network, where there is huge demand for gold amongst the citizens, amongst the deposit holders, if you like, as a means of regulating the money supply. And it's fascinating. If you look at the chart of the Turkish lira against the dollar, you would think that it's a very volatile chart. It's not. It's constantly depreciating at a almost even rate. It is absolutely remarkable. It's a straight line going from the chart, from the bottom left all the way up to the top right. Or if you invert it to show actually loss of of purchasing power of the lira relative to the US dollar from top left down to bottom right. It's a straight line. This is a managed currency, and gold is central to the management of the currency. So these transactions that go backwards and forwards doesn't mean that gold is going into the market. No, it's not.
What looks like selling pressure can actually be internal stress management, not bearish conviction. According to Alasdair Macleod, Turkey's gold movement may reflect monetary plumbing between commercial banks and central reserves rather than outright liquidation hitting global supply. That matters because headlines often frame selling as weakness while ignoring how failing currencies force governments to recycle gold for stability. For investors, confusing transfers with true supply expansion can distort risk decisions. Next, Alasdair Macleod exposes why reported central bank flows can hide a very different market signal.
It's just sort of oscillating between the Turkish central bank and the commercial banks. So that's the first thing. Now, Russia, you mentioned Russia. Russia sells a bit of gold. Russia has a slight problem. It's playing a very, very expensive game over the Ukraine and so on and so forth. Has very high interest rates and so on. You can see that there are strains, if you like, in the economy. Let's put it no more than that. At the same time as what the Central Bank of Russia has in its reserve position, it is common knowledge, certainly amongst sort of those who are well informed about this situation, that there are at least two other sovereign wealth funds which hold gold. And if you put it all together, they've got probably about 12,000 tons, more than America says it has, which it probably hasn't. So the idea that, Central Bank of Russia sells 3 tons of gold, they don't like gold. I mean, it's a load of rubbish. They're managing it against a situation where they've actually, combined with the sovereign wealth funds, got an enormous amount of gold. And, they're using it as money, which is actually what it is. So that's fine. And the other thing I would say is that, central banks do have this problem from time to time. They need to raise funds for their lovely politicians or whatever. And if they do deals, then very often this is completely off market. And they will sell their gold to another central bank. There are intermediaries who basically do this stuff, and it never hits the market at all.
A small public gold sale can distract investors from much larger hidden reserve positioning. What Alasdair Macleod is highlighting is that sovereign wealth structures may hold strategic metal far beyond what headline reserve data suggests. If true, then official reporting may understate how states treat gold as settlement-grade insurance, while retail is fed simplistic, bearish narratives. That changes portfolio logic because visible selling does not always equal weakening conviction. Next, Alasdair Macleod unravels how off-market deals may bypass price discovery entirely.
So it's completely irrelevant. So anyway, whether central banks really understand this or not, is an open question. But they've got a far better grasp of the relationship between money and credit in Asia because they were never corrupted by macroeconomics. That's where we are.
End of last month, Deutsche Bank, a big German bank, published an amazing report about gold. It was titled "The Return of History: Gold, Dollar, and the Monetary Future," and it analyzed how emerging markets have been accumulating gold. And it concluded that gold might go to $8,000 per troy ounce should emerging markets, central banks want to have 30 or 40% of their reserves in gold, which would be in line with history and also with the developed market central banks. Also, the report stated that it's worth considering whether the buildup in physical gold in emerging markets might be a precursor to a potential return of gold as an anchor for an alternative future monetary system. I mean, I read the report and like, it's exactly how I think, how you think, how we've been discussing this for many years. So what do you make of this report and especially also the timing of such a report?
Well, I have one big question. Why $8,000?
Yeah, they also even had
where-
higher targets. So they have a matrix of all sorts of scenarios, but this was sort of the one that was the most interesting to me because it's quite a realistic scenario. I would say.
I mean, I don't cavil about the argument.
When major banks start publishing goal normalization scenarios, timing matters more than price targets. Alasdair Macleod's argument suggests the real signal may not be the $8,000 number, but why institutional research suddenly legitimizes monetary alternatives once reserve behavior is already shifting. Markets often ignore that analysts follow structural changes after central banks act, not before. For wealth preservation, late narrative shifts can trap savers still trusting outdated fiat assumptions. Next, Alasdair Macleod reveals why institutional forecasts may still understate the deeper monetary contradiction.
But the fact that analysts, and it's not just Deutsche Bank, but the major American banks have done something similar in the sense that they're talking about higher gold prices, and they put they say we expect it to be X by the end of 2027, whatever. I mean, it's quite clear that either they don't actually understand what they're talking about, or alternatively, they do have some understanding what they're talking about, and they're just producing a figure which might be acceptable, if you like, to their readers. Because the reality of the situation is not that being presented. The reality is that we're seeing the end of the fiat currency system. When the fiat currency system ends, either the currency becomes a gold substitute, which, is effectively what the Deutsche Bank report is saying, or alternatively, it goes to zero. And if the currency goes to zero, the value of gold in that currency goes to infinity. So I really just don't see the point of saying it's going to be $8,000 or whatever. But, we live in a world of macroeconomic expectations, if you like, where everything works off computer models and spreadsheets and all the rest of it. And, you can just sort of put in your inputs and you adjust the inputs, do this, do that, and you end up with a computed answer, which has actually got absolutely nothing to do with reality. So that would be my criticism of the report. But having said that, I think the origin of reports like this comes from confused analysts wondering why is it that central banks are buying gold?
When banks publish bullish targets, the bigger risk may be what they still refuse to price honestly. This is where Alasdair Macleod's thesis shifts from forecast watching to questioning whether fiat assumptions behind these models are already breaking. If analysts anchor investors to neat targets like 2027 projections, they may soften the harder discussion around currency credibility itself. For savers, trusting spreadsheet comfort over systemic fragility can quietly destroy purchasing power. Next, Alasdair Macleod exposes why central bank buying may matter more than any headline target.
I mean, after all, they think that their currency, whether it's the euro or whether it's dollars or whatever, for them that's money. That's money. Gold is no longer part of the system. Why is it, therefore, that central banks are buying gold? And so what they do is, they talk to central bankers. I mean, if you're a, senior executive, let's say in Deutsche Bank, of course you know central bankers. You go and talk to them and say, why is it you're buying this stuff? And the central bankers turn around, who particularly in Asia, who have never been part of this macroeconomic myth, if you like, about the relationship between money and credit. And they say quite simply, well, these currencies are basically, full of risk. We don't want to have that risk. And that's why we get into real money. Oh, says the commercial banker. I suppose I don't really understand what you're saying, but it seems to me that there's going to be more demand for gold by central bankers, sovereign wealth funds, even the man in the street, if you like, in Beijing or in Delhi you know, we don't really understand why, but it's quite clear that if this persists, then gold is going to go to $8,000, to pick a figure out of thin air. And I think that's the point about these reports. I mean, they're waking up, they're half awake, they're still sleepy. They don't understand what's really happening to their currencies. And I think that's where we are.
The most dangerous blind spot is when institutions mistake currency familiarity for safety. As Alasdair Macleod points out here, central banks buying gold may reflect distrust in reserve currencies long before commercial analysts fully reprice that reality. That creates a split between what financial elites publicly model and what sovereign actors privately accumulate. For long-term investors, ignoring that divergence means staying exposed to narratives built on outdated confidence. Next, Alasdair Macleod reveals why real money language may signal deeper reserve anxiety.
So this is going to hit very, very hard. Now, under those circumstances, the price relationship between interest rates and gold, that is going to change back and revert back to the 70s situation.
Yeah,
it's quite
because
clear.
in the end, it's about
the risk thing. It's a risk,
and the real interest rate. Like, so even if they jam up these interest rates, but inflation is much higher, then that would be good for gold in the end.
Yeah, it's a risk thing. I mean, at the moment, the risk is seen to be in gold. Higher interest rates bad for gold. That will swap into a situation where the risk is seen in the currencies. And then higher interest rates will be a reflection of the fear that the currency's value is going to really decline more than the compensation in the form of interest rates.
Yeah, markets perhaps they
the
trust.
only way really I can explain it. Yeah.
Yeah, and well said, Alasdair. Thanks for that. But I guess the markets expect Kevin Warsh to be a bit like Volcker in the past, but back in the day, debt levels were much lower, of course. So they have much less room to maneuver than Volcker had in the 80s.
Yes, you're dead right. You're dead right. But I think, look, the other thing, Paul, is that we can forget who is actually running the Fed. It really doesn't matter, because the Fed basically has to respond to the pressure from the politicians. Now, I think the point about Volcker's tenure in the very late 70s, early 80s, was that he was appointed by the politicians basically to protect the currency, which is what he did.
Higher rates are supposed to calm markets, yet sometimes they expose fear inside the currency itself. Alasdair Macleod notes that when inflation outpaces tightening, interest rates can stop being anti-gold signals and become warnings of monetary distrust. That flips the mainstream script because rate hikes may reflect defense, not control. For investors, betting only on textbook Fed logic can miss when capital quietly rotates into protection assets. Next, Alasdair Macleod unravels how political pressure can reshape the entire rate narrative.
He had the mandate to do what he did. If he didn't have that mandate, he wouldn't have been able to do it. So, we turn round. I mean, the politicians, if you like, love it because, you can always blame things that go wrong on the head of the Fed, which is what Trump has been doing with Jay Powell. Basically the blame is that this chap didn't follow instructions. Now, we don't know what these instructions really are because they're not made public. But it is absolutely clear that the leader of any central bank, the head of any central bank, basically has to do what the politicians want. And that really goes beyond trying to ensure there's a veneer of credibility about what, the real situation is. So, I hear that Walsh believes this, believes that, whatever. Fine, but I don't really think it's that material. If he doesn't follow what the politicians say, then he's got a problem. The idea that the central bank is independent from the government is pure illusion.
Yeah, I agree. I had a discussion with William White. You know him too, the former chief economist of the BIS, and he also told me on camera that in the end, central bankers do what politicians want them to do. But for example, Warsh, when he had his first term as a governor at the Federal Reserve Board, he actually resigned because he was against more QE. So he was quite a hawk back in the day. But now, of course, he's appointed by Trump, and Trump also through his public statements wants lower rates and not higher rates. So, I mean, sooner or later, there's going to be a fight between the two of them, right? Because I imagine that Warsh also has some integrity and he has a reputation of being a hawk. At the same time, he needs to please Trump. This is going to be a fight within a few months.
Well,
weeks maybe even.
Yeah, I mean, I'm sorry, I'm a bit more cynical than that. Walsh will do what he's bloody well told. I think it's as simple as that.
The market prices Fed speeches, but political pressure may be the deeper lever. According to Alasdair Macleod, central bank independence can be overstated when policy credibility still depends on political mandates behind closed doors. That contradiction matters because investors often treat rate decisions as purely technical, while ignoring power structures shaping them. For wealth protection, misunderstanding who truly drives policy can distort bond, currency, and gold expectations.